Meet Ben. Yesterday, Ben lost $4,200 in exactly 6 minutes. What? Because Ben thought he was investing, but he was actually gambling with words he didn't understand. He saw a button that said market order and thought it meant, buy now before you miss out. He was wrong. The truth is, the stock market is a machine designed to take money from people who don't speak its language. Statistics show that 90% of beginners fail, not because they are bad at math but because they fall into term traps. They see high numbers and assume growth. They see low numbers and assume a bargain. Today we're giving Ben, and you, the ultimate financial cheat code. We aren't just defining words. We are looking at the cellular logic behind the 10 terms that actually move the needle. By the end of this script, you'll understand the market better than the pros shouting on the news. Pay close attention to term number 7. It's the one lazy ratio that the top 1% use to spot a bargain while everyone else is panicking. If you miss that, you're paying full price for trash. Term 1, the stock. Most people say a stock is a piece of a company. That's too simple. Think of it as collateralized trust. When Ben buys a share of Pizza Corp, he isn't just buying a slice. He is buying a legal claim to the ovens, the secret sauce recipe, and a percentage of every dollar the delivery driver brings back. You are a partial owner of a living, breathing business. But there's a technical split, common versus preferred. Common stock gives Ben a vote on company decisions, which is mostly symbolic. Preferred stock gives you no votes but you get priority. If the pizza shop goes bankrupt, the preferred owners get paid first. For most beginners, common is the standard. Just know that your vote is your equity. Term 2, the exchange. Where does this exchange of ownership happen? The exchange. Think of the NYSE as the old money auction house. Prestigious, physical, and historic. Think of the NASDAQ as the sleek tech lab. It's 100% digital and home to tech giants. If the exchange is the stadium, the stock is the player. You need to know which stadium you're playing in because they have different levels of volatility, the term that determines how much sleep Ben loses at night. Term 3 and 4, bull versus bear. These aren't just animals, they are psychological states. A bull market is fueled by optimism. Prices rise and Ben feels like a genius. A bear market is fueled by fear. Prices drop 20% or more as the oxygen leaves the room. But here is the secret. The bull climbs the stairs but the bear jumps out the window. Prices crash much faster than they climb. If you can't survive the bear's swipe, you don't deserve the bull's gains. Term 5, the index. How do we know if the market is doing well? We use an index. The S&P 500 tracks the 500 biggest companies in the US. If the S&P 500 is up, the economy is generally healthy. If Ben's 3 random AI stocks are up, but the index is down, he's just lucky, not smart. Use the index as your benchmark. If your portfolio isn't beating the S&P 500 over 5 years, you're better off just buying the whole index and going to the beach. Term 6, liquidity. This is the silent killer for beginners. Liquidity is how easily you can turn your stock back into cold, hard cash. A large cap stock like Amazon is highly liquid, it's like water. A penny stock is like wet concrete. You can buy it easily, but when you want to sell, nobody is there to buy it from you. Ben once bought a stock that tripled in value on paper, but because the liquidity was zero, he couldn't sell. He watched his fortune evaporate because the exit door was locked. Term 7, the PE ratio. This is the ratio the top 1% use to spot value. The price to earnings ratio. It tells you how much you are paying for every $1 the company earns. If a tech company has a PE of 100, you're paying a massive premium for hope. If a boring utility company has a PE of 10, it might be a bargain. The trap? A low PE doesn't always mean a deal. Sometimes it's low because the company is dying. Ben once bought a stock with a PE of 2. Turns out they made pagers. Know the context. Term 8, dividends. A dividend is a thank you check from the company's profits. It's the closest thing to a cheat code for wealth. But beware the yield trap. If a company offers a 15% dividend, they are likely bleeding cash and trying to lure people in. Healthy companies like McDonald's pay 2 to 3% and increase it every year. Ben loves dividends because he gets paid even when the bear is in control. Term 9, market cap. Market cap is simply the total weight or value of the company. Large cap companies worth over $10 billion are the aircraft carriers. They are stable and slow but nearly impossible to sink. Small cap companies worth less than $2 billion are the jet skis. Fast and exciting, but one wave of bad news flips them over. Ben used to only buy jet skis. After one market wave, he lost his boat and his lunch. Smart investors balance their fleet. Term 10, volatility and diversification. Volatility is the market's mood swings. If you can't handle a 10% drop in a week, you aren't ready for individual stocks. Your seatbelt is diversification. Don't put all your pizza slices in one box. By spreading money across tech, healthcare, and energy, Ben ensures that one bad sector doesn't bankrupt him. Diversification isn't about hitting the jackpot. It's about staying in the game long enough for compound interest to take over. The most important lesson Ben learned? Time in the market beats timing the market. Ben tried to day trade the lows and highs. He failed. The wealthiest people on earth don't time the market. They wait. The stock market is a machine designed to transfer wealth from the impatient to the patient. So, is the stock market a maze or a gold mine? For Ben, it used to be a maze. But now that he speaks the language, he isn't afraid of the bear. He's waiting for it, because in a bear market, everything goes on sale. If you want your gains to stick, you need to stop guessing and start measuring. We just covered the 10 terms, but there is one secret metric that determines if a stock is actually a scam. I covered that in our video on valuation traps. Be honest, which of these terms was the most confusing before today? Drop it in the comments. And if you're in your 20s, tell me what day of your journey you're on. Stay curious, stay patient, and remember, don't let your emotions trade your money.